So this week's chat is regarding wealth. Obviously last week was success principles, the week before that was business. Next week we will announce the topics for the rest of the year. So this week's chat around wealth. Let's get to the point. What we're going to discuss this week is 7 areas of real estate. And the reason we're going to discuss real estate is definitely a part of the wealth formula. The formula for wealth is relatively simple. The formula for wealth is really about how you create cash flow that happens whether you work or not. The formula for wealth is about creating 2 main things, cash flow and wealth. The first form of cash flow, very evident, is active cash flow, meaning you get a job, you work a job, be it in your own business, be it in someone else's business. But when you work that job, that is what is a part of creating the result for yourself. Now, that income, that active income, needs to be turned into passive income, and that passive income needs to be turned into assets, so hardcore assets that have a serious value in them. So as we get through the 7 things today and we start to really look at what it is that creates wealth and how wealth actually happens, I want you to make sure that you start thinking about your situation of where you're at on a wealth scale. So the first question around wealth is, how wealthy are you? Now, to determine how wealthy you are, we need to determine the definition of wealth. So let's look at the definition of wealth. First and foremost, the definition that I learned earliest on was from a gentleman named Bucky Fuller. And Bucky Fuller was a great teacher around many things of principles of success, principles of wealth, principles of life, inventor of the geodesic dome. At the time of his death, it was quoted that he was the most written up in Who's Who, the most patented person on the planet. Now, I'm not sure if those things are 100% true because they were just written in an article, but what I do know is that Bucky taught one thing about wealth, and that is this definition. He said, wealth is the number of days forward you can live at your current expenditure without having to work. So how many days forward? Now, ultimately, the idea is to get to unlimited, where you have businesses or real estate or investments or things that are creating cash flow for you, whether you work or not. And then therefore you make enough money from your investments to support your life going forward. How many days forward can you live without having to work? So if you stopped working today, how many days forward can you live? Now, I'm lucky enough that for me, if I reply to my own comment, mine is infinite. Now, when I say lucky enough, that's not really luck. It's, as you know, it's not really luck. It's about preparation and planning and all of that sort of stuff. But it's really up to you what you do with your money. So what is your time frame of creating wealth for yourself? How many days forward could you live based on your current investments, your current savings, your current whatever it might be? And that determines what wealth looks like. So ultimately, you know, when you first start out in life, obviously you're at zero. I mean, that's just the first phase of it for all of us, I get. You know, I doubt that many of us, when we first start out, have an infinite number. We weren't all born to parents who left us wealth and therefore had a trust fund that would pay for our entire life. Obviously, you know, some people are that lucky, but very, very few, I would imagine, are actually that lucky of getting to that. So real estate, how does that fit into the puzzle? Okay, so the first thing we have to understand is that, you know, our active income, we want to take a percentage of our active income and invest that percentage of active income to create wealth. So the percentage you invest is up to you. Now, you can, you know, I see people who are making, you know, $250,000, $500,000 a year that invest very little, invest almost nothing. And I see people who are making 50 grand a year who are investing 10 and 20% of their income. The percentage you invest is more important than the amount. Let's put it that way. And if that's your first learning, let's think of it this way. If you could build a habit, and the habit was that every single week you went and invested money, if you could build a habit to every single week go and actually go to the bank and invest, or go and actually do that sort of thing, that habit. And if you can build that in kids, it's even more important if you can build the habit into kids. So, and the YES program is teaching this to young people. So make sure that you get involved or get your young people involved in the YES program. So we take a look at how real estate fits into the whole process of wealth. And knowing that wealth is the number of days forward you can live, we take that active income, we take a percentage of that, and again, it's the percentage that you invest is more important than the amount. So if you're making 50 grand a year and you're investing 5%, then when you get to $1 million a year, if you're investing 5%, or you can increase the percentage. Now, why real estate? Why does real estate come into this equation? Well, real estate comes into the equation because it fits first and foremost our definition of an investment. And that is that it does two things. Number one, it has cash flow, and number two, it has capital gain. So the advantage of real estate being cash flow and capital gain is not really the main advantage, but it meets the criteria. So point number one, it meets the criteria for an investment in that it has cash flow and it has capital gain. First thing, it meets the criterion. Second thing, why do we invest in real estate? Well, essentially what we're looking at for most of our investments is a level of passive investment. Now, real estate isn't fully passive, but it is very close to passive. Now, if you get a good property manager, it can be 99-point-something% passive. Now, on its own, if you're doing the collection of rent, if you're doing the collection of those things, then of course that makes sense. And as you get bigger, as you own more and more real estate, it makes sense to have your own property manager collecting the rents, allocating the people, than paying the 8 to 10% it costs for a property manager. But the second reason we love real estate is its level of passive investment level. Once I buy it, it's a set and forget. I put in a tenant, they take care of paying the rent, or which we'll get to in just a moment, and therefore I take care of the rest. So ultimately, it's the passive level of real estate that I love about it, in that business is very active, but real estate can be very passive. Third reason that we want to be in real estate, and it's a very, very simple one, is that the banks will lend us 80% of the purchase price. Now, I know in some markets it's going to be 60 or 70% or even 50% in some markets. And I know in other markets it's going to be 5 or 10%. But on average, banks will lend around 80% of the value of the property. Now, that to me, the reason that is important, when we look at the banks lending us money, why is that important? Well, let's say I have $200,000, right? If I've got $200,000 and I buy $200,000 worth of shares, then what I control is $200,000 worth of capital gain. If, on the other hand, I take that $200,000 and I invest it in real estate, and I borrow the other 80% of that money, so I've invested 20% and I borrowed 80%, I control the capital gain of a $1 million piece of $1 million asset rather than a $200,000 asset. So my goal with using the bank's money is to control a bigger asset than I could control with my cash. So keeping that in mind is really of importance when it comes to wealth. The bigger the asset I control, then obviously the easier it is for me to build a successful portfolio, because when capital gain happens, it doesn't just happen on the 200,000 that I started with. The capital gain happens on the entire $1 million that I control. Okay, so that brings us to the fourth reason why we want to invest in real estate. And again, type in your questions as soon as you think of them, and we'll move from there. So when you come to the fourth reason, what you understand is that the control of the asset is one thing. Okay, so the fact that I control a $1 million asset, and we'll just stay with those numbers for the rest of this session to make it easy for everyone to understand. The control of that asset is relatively simple. What has to happen, though, is not only do I have the control of that larger asset, I'm getting a return based on the cash invested, not based on the total asset value. So I put $200,000 in. Now let's imagine that real estate is $1 million that I purchased. We put in 20% and borrowed the 80%. So let's imagine that real estate over a period of time doubled. Now, on average, we would assume that would be every 10 years. More markets that are in higher value areas will go about every 7 years. In lower value areas, about every 15 to 20 years. But let's use the average of 10 years. So over 10 years, that asset doubled in value. Okay. So I put in $200,000 in cash. Over 10 years, the asset doubled in value. So it went from $1 million to $2 million, right? So now I have a $2 million asset. I put in 200,000. So over 10 years, I've made $1 million from my 200,000. Now think of that and calculate the return. What's the return? I challenge you to calculate that return for me. What is the return on my 200,000? Forget all other things like rent and tax deductibility and costs and all of that sort of thing. Just forget that. Just use the 200 to the million. What's the, I challenge you to give me the return right there. So that very simply is one of the reasons we love to control a larger asset, because our return is not based on the value of the asset. Our return is based on the cash that we actually put in, called a cash-on-cash return or an internal rate of return. So these are the things that we're looking to develop our portfolio and our results long term. Now, if you start sitting there and thinking to yourself, okay, that all sounds great, but it seems too complex. And yes, you need to do 30x wealth, and yes, you need to read the real estate coach, and yes, you should be doing all of that other gaining of knowledge base. But that brings me to the sixth point. So 80% of the asset we've borrowed, okay? So we've borrowed 80%. We put in our 200,000, we borrowed 800,000 to buy this $1 million asset. Now, that 80% has to be paid somehow. So how do we pay that 80% off? Well, you and I don't pay that 80% off. Okay, you don't pay it, I don't pay it. When we buy that asset, we put in the 200,000, we borrow the 800,000. How does the 800,000 get paid off? Well, we have a tenant. The tenant pays the mortgage for us. The tenant is the one paying your mortgage. So when we look to the 7 points of real estate, what we have to understand is that when we look to how that 800,000 gets paid, and let's imagine I took out a 20-year mortgage on the 800,000, right? Let's imagine that 20-year mortgage, in the first 5 years of the mortgage, the rent didn't cover the mortgage, okay? The first 5 years, I had to put in some extra money every month to help cover the costs of owning the property. For the next 5 years, it paid off the mortgage, and maybe I still had to put in a few dollars to cover the costs, either way. But for the next 10 years, it not only covers the mortgage and the costs, but then it starts to make a little bit of a profit. By the end of 20 years, not only is it paying the mortgage, not only is it paying the costs, but it's also making me a profit, a passive income per month, every single month of renting that property out. Now, why do I mention all of that? Because, you know, you've got to balance it out. Over the 20 years, the rent will pay the mortgage. Over the 20 years, the rent will pay the mortgage and the costs. Now, in the beginning, you may have to put in a little bit every month, so you're going to have to budget for that factor when you're buying any real estate or doing any investment transaction. But by the end of that 20 years, it's paying for it. Now, here's the deal. 20 years into buying that piece of real estate on a 20-year mortgage, the tenant has paid off that mortgage in full. So again, we put in 200,000. This is just the simple math and average math based on different areas. There's a lot of areas where it goes faster than this, and there are a lot of areas where it goes slower. And obviously by watching 30x Wealth and attending all the programs, you'll learn this stuff so that you buy in the areas that goes a lot faster. But let's imagine, year one, I buy the property, I put in 200,000 and I borrow 800, I bought $1 million property. By the end of 10 years, it's doubled, it's now worth 2 million. By the end of 20 years, it's doubled again, it's now worth 4 million. So I put in 200,000, it's now worth $4 million, right? 20 years down the road. It's fully paid off because the tenant paid off the $800,000 mortgage for me over the 20 years. So my 200,000 is now worth 4 million 20 years later, and at the end of that 20 years, the mortgage is fully paid off, so all rent is now mine, all cash flow is now mine 20 years down the road. Now, I'm not saying you would buy and hold everyone. I'm sure you would. There's many strategies, and don't go into the detail right here. We're not going to go into that today. But if you do 30x Wealth, or if you come to my landlord training, then you can go into more detail around that. But here I am, I've put in 200,000. I've now got $4 million worth of real estate that is paying me a cash flow every single month in rental income. even if, and let's just do this crazy thing, right? Even if it didn't grow in value over the 20 years, even if I put in 200, I've now got $1 million asset that's fully paid off. If it did not grow in value over those, it didn't go to 4 million, it didn't, double and double, even if it was still only worth $1 million, okay? I put in 200 and I've now got 20 years later $1 million, okay? So just work out the return. You don't have to be a rocket scientist to realize that that is a great return, that is a great result for that business, or for that investment, I guess, because investing is a business and that's a big part of it. So finally, let's get to the last point of why we love real estate, okay? The last reason why we love real estate investing is it's generational. Okay, it's not something that I will do now and it'll never make money once I'm finished. Like if I build a business that's dependent upon me, then if I die, then the business is gone. But in a real estate scenario, if I buy well, the real estate I buy today will be making money in 100 or 200 or 500 years from now. The real estate I buy today will be making a fortune for generations to come, or to fund foundations, or to fund trusts, or to fund all that sort of thing. So your goal when it comes to wealth is to build something that makes you money whether you get out of bed or not. Your goal when it comes to wealth is to have a level of cash flow and a level of assets that mean you don't ever have to work again. And once you're at that point, then you have choice. You can choose to work. You can choose to be like me. I do these things here because I don't have to work. I choose to do these things. I enjoy doing them. My foundation, which again, if you haven't had your young people go through our foundation, please do that. Make sure they learn it. So it talked about, the wealth mindset. And the challenge with explaining the wealth mindset is that you first of all have to understand the opposite of that, okay? The mindset of someone who doesn't create wealth is, unfortunately, we've been trained since birth, and most people have been trained since birth, in the mindset which is the opposite of the wealth mindset. The mindset of, okay, you've got to go to school, learn at school, 20 years of schooling, or you'll complete your schooling around 20 years of age, 22, 23, whatever the age is you finish schooling. It used to be a lot earlier. Now we just keep pushing it out and pushing it out and pushing it out that yes, no, you can't leave school at 16 or 17. You have to leave school at 24 or 25, which, is getting crazier and crazier in my opinion. The biggest thing you can gain from college is a network. That's why I insist on my kids having jobs. Once they're in their, when they were 15, I insisted on them getting jobs. And when they're in their second year of college, I insist on them getting a job because you'll build a better network by doing it that way. Now, the mindset of wealth is the opposite of the mindset of the average person. And so when you learn the mindset of wealth, it seems so anti everything you've been taught. And that's why, I spend at least 7 days of 30x Wealth dealing around thinking and around mindset and around strategy and approach and all of those things. So to answer that question, the mindset of wealth is one that's actually relatively simple, but it takes a lot of change from the old mindset that was on there. Anyway, finishing up for today. What are your top lessons out of this session? Type it in. What's your top lesson out of this session? I think it's very important to understand each of these 7 rules or the 7 steps of what real estate looks at. Make sure you're reading the books. If you don't have the Wealth Coach, jump on Amazon. If you don't have the Real Estate Coach, jump on Amazon. Read those. If you have not read Billionaire in Training, you're part of the Billionaire in Training group, you better read that one as well. Anyway, take care. Bye for now. We'll be back next week with a different subject. I'll be announcing the subject during the week. Take care. Bye for now. Enjoy being a part of this BIT group and keep inviting your friends and family who want to come on this wealth and success journey with you.